Hello and welcome to another week of Fit and Wealthy, my video diary, where I'll be providing update on my investment portfolio and also do some case study stock analysis so you can learn how to pick and analyze stocks. Let's get into it. Here I'm showing my Roth IRA retirement account where I've topped up my balance. Now it's up to 23K. Also good news, year to date we used to be in the red, but now we're in the green. We're up about $86. I did put in money close to the IRA limit, which is $7,500 per year, and that is because with this video diary I want to be as transparent as possible. I put up money close to the limit. Now this is all the funds that we're going to have to work with for the rest of the year and see how the portfolio will grow. Now let's take a look at how I break up this portfolio into different sectors, starting with big boys. So these are also known as Magnificent Seven, the largest Silicon Valley companies, your Google, Apple, Amazon, Nvidia, Meta, etc. That is making up currently over a third of the S&P 500 index, and down to other sectors, banks, insurance, etc. The goal here is to have a well-diversified portfolio so we don't put all our eggs into one basket. If you're not familiar with finance, the best thing to do is to buy the S&P 500 index so you don't have to worry about picking individual stocks. But with me, I like to get into nitty-gritties, and my investment philosophy is to pare down that 500 number under 100 and hopefully keep the best under 100 number of stocks that will outperform the market. Now let's move into our case study. For our case study, I wanted to come up with a system to pick some random companies, and for that I decided to pick two stocks, one that dropped the most over the past months and one that rose the most over the past months. So for this month we have Applovin and Sandisk. As you can see, Sandisk went up 84% over the past months, while Applovin dropped close to 22%. Let's see what's going on with these companies and delve deeper into their fundamentals. Applovin, despite dropping so much, if you zoom out, it is up a lot over the past 5 months. This is a company that does mobile advertisements on your smartphone, so obviously a company that's very much in demand, and its sales has been growing phenomenally fast. In terms of what drove the drop, Google search will show you an article that says there was a short fund that put up an article saying this company is involved in some sort of money laundering. If that's true or not, time will tell. Short funds are not angels. Sometimes they do these dirty tricks to drop the stock and benefit their position. Sandisk has been growing like a rocket. You can see it started trading beginning of the year and it's already up close to 10x. So this is a company that does memory chips and memory cards, and the reason it's grown so much in the past months, or past 6 months for that matter, is the AI phenomenon. So it can't keep up with the demand for its chips and it's benefiting from it. Now let's dig deeper into its fundamentals. So I've created this Excel spreadsheet. You can see Applovin and Sandisk. In terms of its size, Applovin is the larger of the two, 177 billion, which makes it one of the largest companies actually in the world, larger than some banks and some old oil companies for that matter. It's leverage. These companies don't have too much debt. Their Debt to EBITDA is pretty low, so that's good. These companies are growing really fast. Revenue is up 21% and 40% respectively. In pink columns we have return on investments. Again, both companies show very solid numbers. Return on equity for Applovin is 164%. What this tells you is that this company started out with a relatively small investment, and it's been growing at amazing rate, and at this point it returns more than it took in investments every year. That's how good this company is. In green we look at profitability. Net profit margin for both is pretty solid. Applovin is the better of the two. And in orange we look at how expensive these stocks are at the moment. So this is one of the most important criteria, and where all the matter boils down to the fact Applovin and Sandisk, they are both expensive, especially Applovin, and that's because these companies are growing really fast, you remember. So I did extrapolate their growth for the next 3 years to get give benefit to their growth, and if you do that, their enterprise value to operating income falls to reasonable levels, but still quite expensive, to the point where Applovin is getting 6 out of 10, while Sandisk, if it manages to grow at these phenomenal rates, will become relatively cheap in 3 years. Putting all that together, the weighted score for Applovin is 8.1 and Sandisk gets 9.7. Applovin's score is being brought down by how expensive it is at the moment. Sandisk, if you believe that this AI phenomenon continues to keep up for the next few years, it is a pretty compelling company to add into your investment portfolio. This concludes our deep dive into these case studies. Hopefully you've learned something, and if you'd like to continue to learn about investments like this, then please consider subscribing to this video diary, and I will see you again next week.